Spartans! What is your profession?
Howdy folks, Mark here with Flipside Trading. Fresh off the little spring break action, and boy was that refreshing. And if you haven't been, just to get a quick aside, you should definitely think about making that trip to Moab. I mean, you can see here we're at Fisher Towers. Just stupendous scenery out here in the desert. Great weather for spring break. And you get a size, the immensity as you walk along these paths, and they have ladders, you scramble on boulders, so the kids really dig it. Anyway, get a chance, put that on your bucket list. Speaking of bucket list, we came back and we made our profit goal of $13.95 based on a $1,000 target, so we're good to go. What we want to talk about today is the market seems to be taking a downturn, but we definitely took a more cautious approach because we want to be aware of what is known as BTFD and traders lingo, which is buy the freaking dip. Actually, it's a little more laborious than that, but we'll leave it there for the kids listening at home. So let's take a look on what we do and how we ascertain the environment and then adjust our trades accordingly so we don't get caught. Let's see, let's get over to our trade station, take a look at the charts right here. Okay, as you know, we've been for the past 9 years in a pretty relentless bullish mode. You can see every single time that we came down in support, we had a pretty radical, burst to the upside. Right, you can see it. We had it here, right down here. All the times holding these moving averages, and everything is just, up. Everything up, and not just a little bit up. I mean, up fast. What happens is everyone thinks that the market's going to collapse. They pile in the shorts. And the market makers decide to throw them a curve. They love to rip everyone's head off, so basically put them in a short squeeze. They have stops at an area probably around, say, here for an example. And once those stops are hit, you have to close those stops. And the ways you close that stop is that you have to buy the stock back. So that adds additional buying pressure, which then again causes this type of phenomenon. And that type of phenomenon, if you're short, will definitely put you in the poorhouse. So we have to figure out and basically adjust for that. So even recently here, you can see that we still had this whole buy the freaking dip action. Right here again we hit the support line, and we also had it right here as well, right? A pretty violent move to the upside. So we don't want to get caught on that, even though we're starting to see momentum moving down. We're starting to see the price move down. We want to be bearish. We want to keep ourselves out of that bear trap. So how do we do that? Well, first of all, we also make sure that we take a look here, and if you remember our symmetry discussions before, you can see that right here, when we're looking to go bearish, that there looks to be support that matches up with the symmetry and also this pivot point at around 266. And the key thing is like, okay, I don't want it the market at 266 come back and rip roar and take my head off, right? So we're gonna go ahead and make some adjustments in order to make that happen. So let's take a look at our options chain here, and we'll talk about what's going on. So first of all, you can see that this is the SPX. And a lot of times that when we're going bearish, we're gonna do a call credit spread, meaning that we may, you can see that it's trading here at 25.98. Well, let's call it 2600 for discussion purposes. And we say, okay, we don't want it to get above, in this case, 2800 or something. So normally we put these trades on, we usually go in around here about to see this probability of out of the money, is that the short strike will never be hit, right? So this is kind of the, we shoot here, this 81, 84, 86 is kind of usually our sweet spot, where it gives us enough leeway to let the market breathe, so we don't have to be exactly right. At the same time, the closer we are to where the stock is trading, the higher premium we can bring in. And so let's just look at that for example. So let's look here at the 83%. And we say, okay, we're going to go ahead and sell this vertical. And let's see, it's all the way up here. And we look, when we sell this vertical, you can see you could bring in $1.10 credit. Well, you know, we know that we have a chance that this market may rebound and snap back and kind of that short squeeze at any moment. So what we're doing, instead of being at this 83%, we move things down to this 92%. So we have a higher probability, but we're going to go ahead and you'll see that we're going to take in a little bit less profit. And you can see here we're only going to take 40 cents. So you get the idea that, yeah, okay, we're not going to take as much money, but we're definitely going to be safer, right? We have a higher probability of success because we're allowing for the increased volatility in the market and also the historical purposes. But the great thing is that you guys have seen we're able to do that. We're able to take a little less profit. We're able to move ourselves in the comfort zone, but still make our overall target of $1,000 a week. So keep this in mind as you go forward. This is what you really want to adjust your spreads and not say, hey, I'm going to stay with 83%. You can't do that. Once the market expands with the volatility, you need to move it back. You need to give yourself some more room to make sure that your assumptions are correct. Okay, that's how we do it. That's how we help to put money in everyone's pocket. And this is Mark here signing off, and we'll catch you on the flip side. Thanks.